What's up, guys? Welcome back to another episode of Behind the Facade. I am your host, Gavin J. Gallagher, and on this podcast, I explore the mental and emotional game often playing out subconsciously both in your mind and the mind of everyone else in the real estate or property investment market. The key to success in this game is to master your mindset and behavior, to take control of your thoughts, your emotions, and most importantly, your ego. Welcome to the show. Guys, real quick, if you're serious about scaling your property investments, then you need to check out my Elite Property Accelerator. Whether you are stuck on raising capital or structuring deals, or indeed just finding the right opportunity, this is the blueprint you need to take your portfolio and your finances to the next level. No fluff, just real world strategies that work. So guys, hit the link below. It says learn more, and I shall see you inside. What's up, guys? Welcome back to another episode. And I'm just back from Tenerife, and I have some interesting stories to tell, but I'm going to leave that till Monday's episode when I'm going to be talking about resilience. Today's episode is a guest interview, and I'm going all the way to the other side of the world for this conversation. The conversation is with a guest based in Hawaii, of all places. And so this is going to be a really interesting conversation for a lot of you because albeit there's a couple of technical glitches in this, so it's slightly truncated from its original length due to my internet cutting off right in the middle of the call. So apologies in advance if it seems like it's truncated at some point. But I'm speaking with Lane Kawaoka, and Lane is a former engineer who turned to real estate investment. And he's a podcaster like myself. He's an author of a book called The Wealth Elevator. And he is also a person who has put together what is effectively a private equity firm. And he has raised enough money to have more than $2 billion in assets under management, working with about 900 investors. So Lane knows his stuff. And there's some really interesting discussion around just traditional investment strategy, buy to hold, where to buy, the type of housing that seems to be working for him, certainly. He talks about workforce housing and the increasing population of the lower middle class and how he uses census data, and he buys remotely. Like, he is based in Hawaii, but he doesn't buy in Hawaii. He buys in secondary and tertiary markets. So it's a very interesting call. And the book, The Wealth Elevator, he's going to explain a little bit about it, but I think it's well worth checking it out because it talks about the actionable steps to help you move up the wealth elevator. Sure, look, I'll let Lane do the talking. Without further ado, my conversation with Lane Kawaoka. Lane Kawaoka, welcome to the podcast.
Hey, thanks for having me, Gavin. Aloha, everybody.
Aloha, yeah, I'm glad you said that because the first thing I was going to say with a name like I've just sort of probably botched trying to get the pronunciation. You're clearly from Hawaii originally, and you're based there as we speak. And so tell us give us your elevator pitch, Lane.
Yeah, so my previous life, I used to be an engineer, working in civil engineering. That was kind of why I went to school and studied so hard. And then I invested in the traditional retirement accounts that we're all taught to, but started to buy a rental property. And that was kind of where I got off this beaten path of traditional investing and got on this path of passive cash flow. Took me a while, right? Because this is not the get rich quick scheme, but amassed a pretty large portfolio. And, today we try and give back to others. I've got a new book, The Wealth Elevator, which kind of breaks down the different floors of this wealth building journey as I've been on over the last decade plus. And, just trying to spread the good word out there.
Sounds great. And before we started recording, we were talking about the fact that you mentioned Rich Dad Poor Dad. That would be a book that a lot of our listeners, I'm sure, have come across in there. You created it with more actionable items, which is interesting point, because a lot of people, when they're on this journey, they're looking for what's the next step I need to take. And so I hope today we'll be able to jump into a couple of items like that we can go into and help people on their journey.
Yeah, yeah, and I think at least speaking for myself, I had to initiate good paying job. And as I break it down in the wealth elevator, there's different floors or paradigms to the wealth building journey. A lot of the books out there, in America, we have Dave Ramsey, CZ Orman, guys are in debt, trying to get out of debt. A lot of the information is just, basic personal finance. And I guess the Kiyosaki books, he kind of brings people up to the next level of, being, not being an employee, paying less taxes. But, this is the Behind the Facade podcast, right? A lot of those books are written to push people into educational programs and whatnot. And, a lot of it is just mindset, and, you come out really motivated, and it's a great book, right? In terms of mindset, cash flow quadrant especially, but you're all excited and you're like, well, what the heck do I do now? So, that was kind of where I was at a loss. And, I got on this kind of elevator by, buying little rental properties as I was working my full-time engineering job. And, just started to, nothing special. I didn't flip houses, didn't wholesale houses. I didn't, go in with no money down, right? Like I just bought properties with proper 20% down payments, and just kept saving my money. And over the years, I think I bought my first property in 2009. And by 2015, I had 11 of those little rental properties. So it took a while, right, even to get to that point cycle.
And I think that's an important point. It's important to point that out, because a lot of people, when they're thinking about getting into property, they think about it as some sort of a panacea of, you're going to suddenly hit the big time. And I had some fortunate deals that, did really well very quickly, but generally speaking, that's not how it plays out. And you've got
most people think of like house flipping shows, right? Like you buy it for this much and you triple or quadruple your money. A lot of it's cool. But I don't do any of that type of stuff, right? That's very, very, very risky. Right. The type of investing I'm into is just buy and hold investing, something anybody can do. And especially if you're a high paid professional, right, where you're working more than 40, 50 hours a week at a day job, or you run your own business where you probably make a higher multiple than little rental properties, but you want to put money on the side to grow for you passively over time. And you get the nice tax benefits too, especially here in America. And that's kind of where like the first thing we were talking earlier before we started the show, I think one of the biggest mistakes people make is they want to buy a property in their backyard or in the best school district or, where, on the beach somewhere. And oftentimes that is the worst investments. And we start always, in the book, we start with the numbers, right? And one of the biggest things is the rent to value ratio, where you take the monthly rent price divided by the purchase price, and you're looking for something 1% or higher.
Yeah, per month. Yeah. Yeah, we've I've over the years I've noticed that the places that you might want to live yourself because it's a beautiful place or it's a nice neighborhood, or oftentimes they have a very low yield rental return, whereas the places that are maybe a little bit rougher, maybe a bit more working class, those actually have a lot of the time a better investment return. And now, of course, there's variations to that. If you go and look at trophy assets in the best shopping streets and stuff, that's obviously that's kind of like the trophy assets that the super wealthy would go after. But for the general person who's out there investing, it's a lot of the time it's just people that are looking for a simple housing strategy, and that's how you go about it.
Yeah, and you have more people to rent it to. Right.
Yeah, exactly. And it's funny, I had this conversation with somebody before. We were talking about if you had $1 million to invest and you had a choice of buying one property worth $1 million or 10 properties worth $100,000, which is the better investment? And the problem is that the person that goes after the $1 million, you need one tenant to pay you the rent on that, we'll say. And in the event of some sort of a downturn, that rent might be cut in half because the number of people that are able to afford it has dropped or whatever. Whereas if you're buying a property and that's producing 100,000, the rent might be small, but the accumulated, 10 properties producing this small rent, it doesn't fall so far in the event of a downturn or something like that. And so it's actually, you can protect your cash flow and obviously the diversification of having spread across 10 different tenants as well makes sense.
Yeah, so certainly true. Certainly true. I think the way we look at it is at the end of the day, our investment thesis is workforce housing. I think the biggest thing is, real estate's pretty simple. A lot of it is just job growth and population growth, whether one precedes the other. But here in America, especially in, certain parts of the country, you have an increasing population, but more importantly, an increasing population of the lower middle class. We have immigration and generally, unfortunately here, I don't know how it is where you're at, but certainly how it is in Asia, the middle class is shrinking and becoming part of the lower middle class, and the elites are getting better, of course, right?
Yeah.
But we essentially play the game of like Procter and Gamble or like these commodity products where you sort of cater to the masses in terms of the product that you're trying to put out there because the demand is ever growing and ever consistent.
Yeah, it's a very good point. And tell us, Lane, you're based in Hawaii, but you don't invest in Hawaii. How do you go about deploying capital at a distance like that? Do you spend a lot of time traveling, or do you have local partners that you work with?
Yeah, so even when I started, I always used little single family home property managers to manage my assets. I spent a lot of time in Seattle, Washington, which is another primary market. So primary markets are, as we were talking earlier, places you may not necessarily want to invest for cash flow because they're the sexy places to live. They're going to be kind of overpriced, right? People want to live there. They overpay for houses. But hey, great place to live, right? As the saying says.
Austin, Texas is another one that I'm hearing all the time and stuff.
Yeah, a lot of, well, in America, we call them red states, right? More of the places where the laws are more on the landlord side. And typically these places are a little bit more economic growth driven. So, we try and stay away from primary markets and blue states. And we look for these more emerging markets with these other types of tenant bases. And what we try to also look for is, good job growth. But for the most part, we can kind of use big, readily available data, which is the census data, population, right? And a lot of this is very long-term growing trends. So it's pretty easy to, it's not rocket science, is what I'm saying. Yeah. So even when I first started to, my first 11 rental properties were in Birmingham, Alabama, Indianapolis, Indiana, and Atlanta, Georgia, right? Not the sexiest of places, but kind of fits that category of more of a secondary or tertiary market, as we call it. And when I'm buying these properties, it's typically not in the high end, but it's also not the low end, right? We're not slumlords here. There's a nice little sweet spot in the middle. We rank these, and I have a free e-course if people want to check out where we go into like what is an A-class rental, B-class, C-class, sort of dictated on how old the asset is. When you go after like this, the C-class, you run into a lot of tenant issues. When you run into the A-class, as I mentioned, you don't get the rents per the value of the property that you're looking for. So there's a bit of a trade-off there. So we kind of look for people are numbers driven out there, like a lot of our investors who are engineers. Maybe take 80% of the median home price out there, which I'm sure you could chat GPT that thing and figure that out in your local area, or, just kind of test certain markets where you're at. And those are the types of properties we're kind of focusing in on.
Yeah. That's interesting. Take us back, Lane, to you're a busy engineer and you're working a full-time job. You're buying on the side I guess you'd call it kind of like a side hustle nearly. At what stage did you feel it was time to exit your job and you had a sufficient income coming in that you felt like you could actually go all in on your investment portfolio?
Yeah, so I mentioned earlier, like around 2015, about 6-7 years into the game, I had 11 rental properties. At that point, I maybe had a few $1,000s of passive cash flow coming in after expenses such as taxes, insurance, and I think that's the things as an investor you got to kind of understand all those little hidden expenses in there. But at that point, obviously that was a nice. Who doesn't want an extra few $1,000s a month? But it wasn't replacing my engineering salary to that extent.
Yeah.
I had started buying larger apartments at that point, and we started to syndicate deals with outside investors coming in, and I'd probably done that for maybe about a year or two until I was like, you know what, it's a little irresponsible for me to stay at this engineering job and kind of work two jobs at the same time.
Yeah. Yeah.
But if it weren't for that, I would probably be still hiding. Well, maybe I would have retired, but I probably would have been hiding out at the engineering job still to this day. And that's kind of what I help people do is, like if people have, money solves problems. For people who say it doesn't, get some, and we'll show you.
Yeah.
But if people had, few $1,000s of passive income coming in every month, and it expanded slowly over time, you notice that you would make different life choices, right? You would start to become a more abundance mindset, and you'd start to, maybe don't go after that job that you get a 20% more pay, and you go after that lower paying job for quality of life. And that was actually what I started to do myself, right? Like when I first started my career, I worked for a private company, very high stress, lower quality of life, was traveling 100% of the time. Luckily, I didn't have any family back then.
Yeah.
But at that point, as I started to get more passive income, I picked easier jobs, which also made the side gig, which ultimately became the full-time gig later on, a lot easier to do. But, for most people, they just want to find the job that they enjoy working with and they sort of enjoy, and just invest on the side passively.
The big thing is having options. It's a little bit like what you said. You can. A lot of the people that I work with inside, I have a coaching business as well, and this coaching business, most of the guys that I'm dealing with would be, let's say, contractors that are working for clients building houses, or they'd be professionals inside the construction industry or something like that, and they enjoy the work that they do. But they're very conscious of the fact that they have to work for their living. And the passive income aspect gives them just that little option that in the event at some point in the future, if they wanted to take a step back, that they're not going to see this big drop off in their income, that they actually have the alternative income source there coming in. And for guys in construction, it's important because you get to a certain age and you just don't have the same level of strength or energy that you used to as a younger guy. And so the idea of working on a building site, in your 50s is kind of hard going for guys. And so that's when you want to have the secondary income coming in that you can kind of ease back.
Yeah, exactly right. I mean, part of it too is, the way we teach it, you have the alternative investing where you get, better returns and from off of the traditional investments, right? And that's the issue, right? Whether you're in America, Europe, Asia, when you invest in traditional investments with the big institutions, there's a reason why they're the institutions, right? They take a large fee cut, a lot of hidden fees. And that was where very early on, I was making like 20-30% returns on my money with my little rental properties. And I was like, why would I want to put my money in my 401k and make 8 to 10% supposedly, right? Today, I think it's less. That's the assumption. And then I was like, well, who the heck took my money? Where did it all go? And that's kind of where, we try to teach people like, hey, if you just educate yourself a little bit, get off the beaten path, there can be a different way of going about this, right? It is possible, right? Don't just take the status quo of, I call it the Wizard of Oz effect, right? Everybody thought the Wizard of Oz was this big, like, ghostly character, but when you check behind the curtain, you're like, don't pay attention to that. And that's essentially what Wall Street is, or, the traditional investments out there. It's these big companies, and, it's nothing special. They try to make it like it's super complicated just to scare you, but it really isn't, especially when you're involved in simple things like rental real estate.
Yeah, it's so true. And tell us, Lane, in the process of building your portfolio, so you were building a portfolio that was rental property just for yourself. And then around 2015, you started to syndicate. So what did that first deal look like? Was it, a couple of guys, or did you go for the bigger stuff straight away?
Yeah, I mean, when we first got started, we would buy a lot of these, like 50 units, so relatively small. Um, we would bring in maybe, I don't know, few dozen investors at 50,000. And these were Class C properties, so a little bit rougher tenant base, which we soon after, got tired of dealing with, difficult tenants. A lot of these tenants, in those lower realms, almost slumlord, getting to that spectrum, but not quite. They'll be paying 80% of the time.
Yeah, yeah.
I
So you
mean,
got to
these
build
people
in
are like,
debt and the voids and stuff. Yeah.
yeah, I mean, you just have to write that debt off. But the asset is profitable enough to overcome that. But this is kind of where, if you're thinking about this and you're getting a little queasy, remember you should be doing a property manager as your buffer to be dealing directly with the tenants and collecting the checks and dealing with the all the enforcement of this. And then this is kind of why investors like to invest through a syndication, because they have an asset manager managing the manager. It'd be us
Yeah.
kind of working on that on their behalf, and they're insulated by an extra step, and they're also LP partner with a limited liability position. So this kind of form allows investors to invest in many different deals across the country and different asset classes. We like apartments, but people will invest in self storage, mobile home parks, shopping centers, you name it. And this kind of I never realized it, but we were kind of essentially a micro private equity company developing into, right?
Yeah, yeah. You've grown your portfolio now to is it 10,000 units?
Yeah, so we purchased, I mean, we've maybe done like 60, 70 plus projects, total $2 billion plus. I don't think we're an institution, but, I think we're certainly not a new
Getting there.
guy anymore.
Yeah.
Yeah.
And what does your team look like managing 2 billion worth of property?
Yeah. So we have a relatively small core team, but a lot of our folks that are boots on the ground are third party property management.
Got it.
So there's a lot of debate whether you want to take this in house or put it, use third party people like how we do. I generally think that the way we're doing it with the third party is better because, we've changed property management out pretty regularly. I think maybe they last maybe a couple of years, and it kind of keeps them accountable. This is the Behind the Facade podcast. So I'll tell you, like, property management companies is not the business you want to be into. It's probably one of the lowest margin, highest BS business you have to deal with. And so, it's something that we don't necessarily want to get into. Luckily, there's a lot of companies that are in that type of business line that we can choose from.
Yeah, I've always questioned why people go after that because it is an area that has been commoditized. I remember, apartment buildings that I maybe have invested in or lived in, and every year you would get this letter in from the property manager, and it would say, "Oh, we'd like to increase our fees this year," and there'd be uproar, and they'd go out, and all of the owners would get together, and they would go into the market, and they'd ask some property manager to come in and give an alternative quote. And straight away, that person, just as soon as they ask for a pay rise, they're gone. And then somebody else comes in at the lower fee. And I can remember just thinking, it's so commoditized, like that there's no loyalty whatsoever to that person. As soon as they want more, and maybe they just, like the work that's involved, it is a lot of hassle, it's a lot of grief. And so maybe it is justified that they get more. But then everyone seems to just not value it.
Yeah. I mean, you don't need a college education to do it. In fact, you need a kind of a smart person to do it. So the high quality people get the heck out of that profession and move on. But, from what I see, a lot of people will use it as their first job out of college, because you are kind of given a lot of responsibility. You do learn a lot. But yeah, like you said, it's a turnstile type of gig for sure.
And do you see, in terms of your own sort of, let's say, a 10-year plan for yourself, do you see yourself growing your business to, doubling to 20,000, or do you see yourself packaging this up and sell off the entire portfolio and make a nice payment and then go back to having a small little operation yourself?
I think like the blueprint I use is other family offices that kind of are in this business line. And this is kind of what I talk about in the Wealth Elevator book, right? Like in the Wealth Elevator book, we identify the people in the basement getting out of debt, and then kind of where I was buying the first rental, which is the first floor. Most of our clients, they're accredited investors. They want to invest in these types of projects are on the second or third floor of the Wealth Elevator. But beyond that, once you hit 20 million, $50 million in net worth, you start to turn the business into like a business. And I think that's kind of where we'd like to head eventually, where we're not a publicly traded company. We like the flexibility of that. We don't have to deal with, people who don't understand the business and not long-term driven. And we can kind of keep doing projects as they come up, and not forced to do projects as they come up. The way we look at it, we look for multifamily value add projects. We develop multifamily from scratch. And now we also look to buy businesses, right? The common thread here is, a reliable operator, right? That person in the middle, which ultimately is, people who are business owners understand it's relationships. All of this is a relationship game.
And what kind of businesses do you look at? I'm curious.
So on a couple sides, on the virtual side and the brick and mortar side. So the brick and mortar side, a lot of like vendors that we've worked with in the past, like pool cleaning companies, plumbing, property management companies. I know we kind of foo-fooed that in the big, yes. And the common thread there is that we've worked with them in the past.
Got it.
We know the owner intimately.
Yeah.
On the other side there, other virtual companies in the SaaS, e-commerce, and content website side, either B2B, B2C. I think a lot of that is like for the average person out there have no concept of these types of companies out there unless you're an e-commerce Amazon seller out there, right? Then this stuff very intimately and now your ears are perking up. But, I think this is where, as I think, again, like what family offices do is they network with people on their level. So I'll join different mastermind groups and my partners will join, different groups. And, you start to realize that there is a proverbial country club out there of people who are doing business with each other and they're in vicinity with each other and they can find bolt-on or synergistic strategies. Like for example, maybe even an engineering firm, right? Which is more in the professional services realm. Good firm that wants to buy out a competitor, needs $1 million. So we joint venture on that acquisition with them. They can buy out a competitor, take out their competition, and then we get a split of those profits.
Yeah, I understand. Makes sense. My background is architecture, actually, so that's where I qualified. I have a similar path to yourself insofar as started as an architect, bought my own, like I was running my own very small firm, making tiny amount of money on domestic sort of extensions and all this. And then I bought a little property deal myself and I quintupled my money in about 6 months. And I can remember just saying, why am I doing this other architecture stuff? Like I should just be all in on property investing and stuff. I'm looking at the number of investors. You're working with 928 investors. Is that right?
Yeah, there's a lot of them. I mean, it essentially started back in 2015, 16. It started to build the list. And, in the beginning, it was very intimate, right? We would meet a lot of people face to face. Over the years, definitely kind of grew, some referrals here or there, contributed to the snowball, getting bigger and bigger. But, it's, I think people understand the investment thesis, right? Invest in things that cater towards the working middle class. Or, when we get into businesses, we develop more workforce housing. We don't develop luxury, sexy, high-end condos and things like that.
Yeah.
So people, I think it attracts the certain type of blue collar focus investor. And then now when you start to invest in businesses, like we're not investing in venture capital, angel investing, pie in the sky type of things. Just like the apartments, right? We have an existing P&L that we can look at. All right, this is the income, this is the expenses, this is how it's been running the last 2 years. With the business, the same thing. I can take a look at your architecture company and see your overhead and see your expenses and see how much you profit. And, a lot of this is just, business brokerage where you can sort of see what the evaluation is. And now we dance and now we negotiate. And just like when you're buying a little single family home discount, you can, in theory, you can get a lot more leverage with, obviously a lot of business owners are retiring now. And I think there's a statistic out there. I think it came from like Cody Sanchez or something, like only like a third of these businesses have a decent succession plan. And they just need to sell and exit.
Yeah, I saw something similar recently, and they were talking about, the baby boomers, that they're all, most of them are in their 70s, heading into their 80s. In the next decade or so, there's going to be a major transfer of wealth from that generation down to the next generation. And for a lot of people, that's going to trigger transactions, and it's going to trigger, kind of a shake-up in the market. So it's interesting to be in that position that you're actually out there buying now, because obviously that gives you an advantage.
Yeah, I actually just got off a recording with my business coach. I'm in a group called Vistage, which is for CEOs. I think it might be international too.
I know, I've heard of Vistage. Somebody else I spoke to recently was on it, yeah.
Yeah, but we did a 2-hour long webinar on, the dynamics between the baby boomers, exactly what you said. They're exiting now, and in the next 10 years, it's just going to be the millennials and the Gen Xers trying to deal with the late millennials and the zingers. I don't know, who knows what we call them, right? But it's a changing of the guard, certainly. And the way we see it on our private equity side is if we can selectively pick out these business owners, there's a lot of opportunity there for us, right? In terms of buying up things undervalued. Another thing that I'll point out in that private equity space, I think most private equity, when people think of private equity, think of larger companies like, Blackstone, right? There's a lot of bigger, not as big ones, but essentially they play the same game where they come in, they pump it up and they dump it, right? A lot of business owners, such as probably yourself and myself, we've grown accustomed to the ATM machine, the cash flow coming from the business, and we enjoy, what we've built. We want a nice little payday, which is what we provide, but we want you to stay in the seat and give you some, purpose in life, right? If not just for your employees. So we kind of play the role more as micro PE, where we allow the owner operator to stay involved, because we also are not looking to exit and pump and dump the asset. The way we structure our projects from a tax perspective, it kind of makes more sense for us to kind of hold it long term for the great cash flow.
Well, if it's good cash flow, yeah, exactly. Why would you want to exit out of that? Yeah, interesting. And where do you see the market going, Lane? I mean, we have a changing of the guard, new president coming in this month.
Well, on the commercial real estate side here in America, prices have come down quite drastically, 20 to 30% off the highs of a couple of years ago, caused by 40-year high of interest rates, which is the quickest increase in history. It rocked the commercial real estate world, not necessarily residential real estate, very different dynamic in there with the 30-year mortgages. But commercial real estate, if you're a contrarian investor looking for things that have been beat up and undervalued, it's right there. And traditionally at post peak of the interest rate cycle hikes, which is now, that's when you start to see the stock market, weakness there. Now, as far as, the presidency, most people will say that it doesn't have a huge impact on things. I certainly think we'll see some nice tax breaks for real estate investors, certainly because the president owns a lot of real estate. Why would he not? But again, there's always a world of uncertainty and you never know. And that's why I say we'll invest in things that are more of a long-term thesis, like workforce housing. People need a place to live, especially affordable places. And when you can pick up a good architecture firm for 30% cheaper because the owner is going through some type of distress, divorce, death, sickness, illness, or just freaking tired of his doing it, and his kids are kind of spoiled and don't want to take over the reins, then that's a great place where you can buy value right there.
Lane, apologies, we've had a technical issue there. We've been trying to figure it out. What I'd love to know is just, I always ask these questions of my guests when it comes to the end of the podcast. And, at what age are you now? Do you mind me asking?
Oh, it doesn't matter. It all matters how much net worth you have, is what I say. So if you're somebody in your 55 to 60 range, which is, I think, most of our investors, and you're not to $3 to $4 million yet, you got to go. You got to get moving. Because $1 million, $1.5 million is not enough, especially 20 years from now. And that's kind of where it's kind of a smart ass answer, but that's kind of where I'm kind of beyond my years, right? Like, I've been at this since I graduated, like pretty much when I turned 20. I mean, I've been investing since my teen years, right? I had at least 20 years of compounding interest, right? A lot of my clients have come to me when they finally get their head on their shoulders and when they're 40. It's going to take them to their 60 to get to where I'm at today, right?
Yeah.
And that's what I say, like, it's the Carmen dating. It's where you're at. How long have you been in this? This is not a get rich quick scheme that we're talking about, right? I mean, when you make a little bit more returns, but more importantly, pay less taxes. And then we also employ a strategy called infinite banking, where we run our money through our own privatized bank for a little bit extra return there too. We've got e-courses on this, and it's also in the book. If people want to check it out, they can go to thewealthelevator.com/master. I think it's a free gift for you guys there, but it takes a while, right? Like, this stuff is not investing in some alternative coin or an angel investment. It's
not a Hail Mary. Yeah.
Oh, correct. And we also preach diversifying into many, many, many projects. So it's going to take a lot of time to fully deploy. But at least it's, I certainly can say that it's worked for me in the past, right? And I found a group of investors, credit investors, that totally, I never knew this world existed, right? Where these wealthy people were quietly doing these set of strategies. And it was totally different than what my parents taught me, certainly what was being taught in the cubicle world around me. But very, silently, people were doing these types of strategies, but it wasn't something that the average guy couldn't do. It was just, unfortunately, all the marketing from the traditional investing institutions put out there want you to go invest in their target date index funds, etc.
Sure, they've got 500 or 600 staff to pay salaries to, so they need to kind of keep it churning.
I mean, how else do they have these large buildings, right?
Yeah, that's true. They have to pay for all this stuff. Lane, I'm conscious of the time. You've got to go in a couple of minutes. The reason I was asking your age was really just one of the questions I like to ask is, if you were speaking to young 18-year-old Lane, although it sounds like you kind of partially answered this already, is like, what advice would you give your 18-year-old self?
I mean, I think I got lucky, right? Like, I grew up in a family that was really frugal with my money. I always saved my money. Even after college, I didn't have an amazing salary, but I was able to save 30, 40, 50 grand per year. And I plowed that right into buying houses, down payments. I think if along the line, the only change I would make is like not do 15-year mortgages, do the longer term 30-year ones, because my debt payments are less. Even though I pay more debt in the long term, that's kind of one of those arguments where the average guy just doesn't understand that concept, right? And this is why you need to take advice from people who are financially free and understand money. But yeah, I don't think I should have bought 11 rental properties. I should have bought maybe just one or two and then moved on to larger syndications and private placements. But I didn't have a rich uncle. I didn't, have credit investors around me in my late 20s. Eventually did find them in my early 30s, and of course corrected from there. But that's kind of why I wrote the book, The Wealth Elevator, right? To put it out there, all the things that I've kind of learned along the journey, and specifically where you are at in the journey, right? There's different tactics that you follow.
Well, I'll put links in the show notes for the various things that the resources you've mentioned and stuff like that. If somebody wanted to reach out and learn more about you, Lane, how do they do that?
Yeah. So if you guys like podcasts, I've been doing my podcast since 2016, and it's called The Wealth Elevator. I'm sure you can find it on iTunes, Google Play. If you want to check out the book, you can check it out on Amazon, The Wealth Elevator. If you buy a copy and email us, we can send you the audiobook and PDF version for free. And if you want to share it with your friends too, I guess I can't stop you. Our email address is lane@thewealthelevator.com.
Great. Well, Lane, it's been a real pleasure. Thanks so much for your time. Sorry about the technical difficulties, and I wish you the best of luck with all of your endeavors.
All right. Thanks, Gavin.
All right, guys, I hope you enjoyed that call with Lane. I found it very interesting myself, and I might even ask Lane back on the episode for a follow-on call. What I would like to point out to you is that I have my property starter kit course coming out next week. I'll be launching it this coming week, and so keep an eye out for that. On Monday's call, I'm going to be referencing it, and I'm going to be dropping a link so that you guys, if you're interested in it, you can sign up for it there and then. So guys, wishing you a great week, and speak to you in the next one. Thank you for tuning in to another episode of Behind the Facade. If you enjoyed the show or found it useful in any way, could I please ask you to take a moment to leave a review over on iTunes or Spotify or wherever you listen to podcasts. There is no algorithm for the podcast, and so the only way we can get other people to find out about it is when it's shared by you. So if you can do that, it'd be great. If you have any questions or topics you'd like me to cover on future episodes, please connect with me via the school community, or just send me a message on Instagram or wherever. You'll see the links in the show notes below. You can stay up to date with all of my content and the projects that I'm working on by signing up for my weekly newsletter, and you'll find a link below in the show notes for that too. That's all for now, guys. I'll see you back here same time next week.